Okay, welcome to class number 4. This week we're going to be learning about the Greeks and we're going to be learning about hedging. So this is chapters 8 and 9 of your textbooks. And let's go straight into hedging. So hedging is a term referring to any trading activity that's designed to reduce the risk of a portfolio or a trading book. So a well-hedged trading book is a portfolio that experiences very few gains or losses regardless of market movements. So there's a lot of traders who their goal is to minimize their risk. For example, if you worked at a large investment bank selling derivatives to investors, your goal would be probably to try and make money on the commissions that you charged or the bid-ask spreads that you've charged to your customers, and not really to have huge risk exposures to the market such that a big market move could cause losses in your portfolio. So what a trader like that will do is that they will try to hedge their exposure to market risk. And so there's a variety of ways that can be done. Now, the Greeks is a term used in the option world for the measures of sensitivity of the price of a derivative to changes in individual parameter values while holding all other parameters fixed. So basically, if we break down the risks of the various price changes that will affect the value of an option, and then we give them a Greek letter. So they're referred to as the Greeks simply because we use a different Greek letters to denote each of them. The Greeks are of great importance to an active derivatives trader because they are crucial for understanding the risks that you're exposed to and to keeping those risks appropriate within an options-heavy portfolio. So the first one we're going to look at is delta. And delta is the amount the options price changes for a 1 unit change in the price of the underlying. So when we look back at our payoff diagrams, you can see that it should not be linear. With a future, or if you just own the underlying, for example, as the price of the underlying goes up, the price of that future will go up, or the stock that you're invested in will go up and down in a linear fashion. With options, they don't move in a linear fashion like that. So delta is the amount that the options price is going to change for a 1 unit. Usually we'll say a 1% change in the price of the underlying. Mathematically speaking, it's the first derivative of the options price with respect to the underlying. So let's look at our chart here, and we can see here that when we have our value of our call option before maturity, it's a curved function, as you can see there, because it only takes on that sharp edge right at expiration. And so before maturity, we've got that black line that is the call option price before maturity. And then we've got that blue dashed line, which is a tangent to that line, and that is what our delta is. It's the slope of that line, and as you can see, it's touching the option value right where the spot is right now. So delta is a good approximation for how much the price of that option will change for a small move in the price of the underlying. Now, as you can see, if you move up a lot or down a lot in price from the current spot, that delta line, because it's a linear approximation of a curved function, it moves away from the line, the call option value line. So really, delta helps us know for small changes in price how much our option is likely to change in value. So we can think of it as a ratio comparing the change in the price of the underlying asset to the corresponding change in the price of a derivative. So for example, with calls that have a delta of 0.7, that means that for every $1 that the underlying increases, the call option will be expected to increase in value by 70 cents. And equally for $1 that the underlying falls in value, the call option would be expected to fall by 70 cents. Now that's quite different to a future. A future is actually a delta 1 product. Futures have a delta of 1, and that means that their price should move directly in line. So with a delta of 1 for a $1 change in the price of the underlying, your derivative would move $1. For our deltas on options, they're usually not equal to 1. As I mentioned earlier, delta is a linear approximation of a curved function, and thus it only accurately tracks options value changes for small changes in the price of the underlying. So it's good for telling you what your risk is at the moment, but should there be a big move, you'll have to recalculate your delta. You'll get a new number and you'll have to adjust your hedge based upon that. So let's look at our next slide here, call delta range. The delta of a call option can only range between 0 and 1, and hopefully that makes sense to you. So it has to be a positive number because it's a call option. If you're long a call option, you'd expect that when the underlying goes up in value that you're going to make money, and when the underlying falls in value that you're going to lose money. Now, then we're looking at between 0 and 1, what level is it at? Well, delta will be low at low spots relative to the strike price and high at high spot prices relative to the strike price. And what that really is about is moneyness. So if the spot price is low relative to the strike price, we're talking about an out of the money option. And let's think a little bit about this. If we imagine a really far out of the money option, we'll say, for example, an option with a strike price of 1,000 and the underlying is trading at $1. Even if the underlying doubles and is now at $2, you wouldn't really expect the value of that option to move very much because it's still ages away from hitting the strike price, which is 1,000. So that's an really out of the money option, is going to have a very low delta. Now, if we flip it the other way and we say, well, what about a really deep in the money option? So we'll say if the underlying is trading at 1,000 and the strike price of the option is $1. Well, suddenly now it's almost the same as just being long the underlying, right? Because if the underlying moves from 1,000 to 999, that's not really getting a whole lot closer to the $1 strike price of the option. So it's really going to have to start getting closer to the strike price for that delta to move much below 1. And so then in the middle there, we've got our at the money options. And so an at the money option where the spot price is quite close to the strike price or is the same as the strike price, you're going to see a delta closer to 0.5. And hopefully that makes sense to you, because you can almost think of it that there's a 50% chance of that option being worth something and a 50% chance of it being worth nothing. And therefore it moves half as much as the underlying does. So that is the range of call deltas. So our next slide now is put deltas. And so put deltas are going to be different to call deltas in that the put gains in value as the price of the underlying falls. So once again, it's a very similar chart to the one we looked at for call delta, except of course that the curve is moving in a different direction because it's a put. And once again, we've got this tangent price, and the delta is a linear approximation of that curved function. So once again, it works well for small price moves, but for very large price moves, you're going to have to recalculate your delta. So put delta range is between 0 and -1. And it's a similar thing with moneyness, where deep in the money put is going to have a delta close to -1, and a way out of the money put is going to have a delta closer to 0, and an at the money put will have a delta of around -0.5. So that is put delta. So you can think of the delta of an option as a little bit like being long or short the underlying asset. And so let's think a little bit about how that would work. Well, if you have an option, and if it increases, we'll say if it's an at-the-money option with a delta of 0.5, if for every 1% move up in the underlying, your option increases in value by 0.5%, owning that option gives you a very similar economic impact as if you owned half of the number of shares that you actually own. So if you are long an at-the-money call that controls 100 shares but has a delta of 0.5, it's a lot like being long 50 shares of the underlying, right? Because it doesn't, if you looked at your stock chart at the end of the day and saw that your stock was up 2%, just because you're long a call doesn't mean you've made 2%. You've got a 50 delta call, a 0.5 delta call. So you've actually made 1%, half of the 2%. So you can think about the delta of the option as a lot like being long or short the underlying asset. And for small changes in the price of the underlying, this linear approximation helps you track your valuation movement. So as I said, we'll say if the market in your underlying has moved up 1%, without repricing the option, you can sort of approximate and say, well, the underlying is up 1%. I have a 0.5 or 50 delta call. That means that I've made about 0.5%. Now, if instead you looked at the stock market and saw that your underlying was up 50 or 60%, well, then you're going to have to recalculate your delta, because delta only really works for those small amounts. So we'll have to reprice the option for a large move like that. So put and call delta. Delta is always positive for long calls. So if you're long a call, you always have some positive delta between 0 and 1, and it should always be a negative delta if you are long puts between 0 and -1. Thus, the value of a call option increases with a stock price increase, and the value of a put decreases if the stock prices increases. So a put obviously has a negative relationship with the price of the underlying. Given a European call and put option for the same underlying with the same strike price and the same time to maturity, so this is a little bit like put-call parity, if there's no dividend, the delta of the call minus the delta of the put should equal 1. So let's look at an example of that. If the delta of a call option is known to be 0.3, you can then easily calculate the delta of the corresponding put. So the put with the same expiration, same underlying, and same strike price, we can quickly calculate it by saying 0.3, which is the delta of the call, minus 1, gives us minus 0.7. So the delta of the equivalent put should be minus 0.7. To calculate the delta of the corresponding call from the delta of a put, then all you have to do is add 1 to the put delta. So we'll say, for example, there we know that the put has a delta of minus 0.7. If we add 1 to that, we end up with 0.3. So that would be the delta of the corresponding call. Hopefully that makes sense to you guys. So delta hedging. The total delta of a portfolio of options on the same underlying asset can be calculated by simply summing them up. So if you're an options trader who has been buying and selling both puts and calls all on the same underlying, we'll say if it's on a stock index, and throughout the day you're sometimes buying, you're sometimes selling, and it's sometimes calls, sometimes puts, you're able to just sum up all of those deltas, and that will tell you your portfolio delta. Now, the delta of the underlying asset, as I mentioned earlier, is always 1. So if we wanted to hedge our market exposure, if you've got a portfolio of, we'll say, 5 different options, some are puts, some are calls, but they're all on the same underlying, we can simply sum up their deltas. That tells us how much market exposure we have to that underlying. And because its delta is always 1, we can then just either buy or sell the underlying to neutralize our delta. And what that will mean is that for at least small price changes in the price of the underlying, you wouldn't expect to see big swings in your profit and loss. So you'd expect to be reasonably hedged. So that's a use of delta. It's quite useful in hedging, in particular portfolios of options where you've lots of different options. So that's delta. Hopefully you guys understand delta. It's not really too complicated. It's quite simply, how much does the value of my option change for a 1% change in the value of the options underlying? And that's delta. So now we're going to move on to our next Greek, and that is theta. And theta measures the sensitivity of option values to the passage of time. So we talked about this in previous classes, that obviously the more time an option has to expiration, the more it's worth. And so as time is passing, an option's price would be expected to fall due to the passage of time. And so option traders refer to this as time decay. And theta is the first derivative, mathematically speaking, it's the first derivative of the Black-Scholes option pricing model with respect to time remaining to maturity. So theta is negative for both long call options and long put options. So it doesn't matter if it's puts or calls. If you own options, you would expect them to fall in value as time is passing. All other things equal. Obviously, if it's moving in your favor, that's something else. But all of our Greeks were assuming that everything else is held equal. And so because there are less days or less hours left for that underlying to make a favorable move, our options are becoming worth less and less as time goes by. Usually you can calculate theta for any length of time, but mostly traders talk about daily theta. And so it's the amount of money you would expect an option to fall in value over one day. Theta is a little different to our other Greeks in that it's not really hedgeable because it's the passing of time. So if you don't want to suffer losses due to the passage of time, you shouldn't buy options. If you're long options, every second that goes by, they will be falling in value at a tiny bit. So you can hedge obviously against delta, as we discussed earlier. You can't really hedge against theta other than by selling other options, but that's a new position. So theta is not really hedgeable, and it is something that if you are long, if you own options, either calls or puts, you suffer losses over time with theta. So our next screen here, or our next slide, is showing theta over time. So we have the option value here. The yellow line, this is obviously a call option because of the shape of the line, and the yellow line would be an option with a long time to maturity. And as time passes, it starts moving forward to next you get I guess that's a wine-colored line, and finally the black line. And on expiration, there's no time left, and the option value is what it is. It's our linear diagrams that we saw in lecture 2. So as time goes by, option value is falling because of the passage of time. And that's just simply that there is no time left or there's less time left for big favorable movements, for news to come out that might move the price of the underlying in the favor of an options owner. So that's theta. Hopefully that makes sense to everyone. And we'll move on to our next Greek. And our next Greek is called Rho. And Rho measures the sensitivity of options prices to changes in interest rates. So within our Black-Scholes model or our binomial tree model, we were always present valuing these expected cash flows. If we change the interest rate in there, if interest rates rise or if interest rates fall, that's going to affect the price of the option, and that's what Rho is measuring. So it is the first derivative of the option value with respect to the risk-free interest rate, which is used in the pricing of options. Rho is typically expressed as how much options prices change if the risk-free interest rate rises or falls by 1%. So we want to know how a change in interest rate is going to affect our options position. Will it increase or decrease the value of the options that we are either long or short? So an increase in the risk-free interest rate would increase the value of call options. So if you're long a call, an increase in the risk-free rate will increase the value of your calls. And if you are long a put, an increase in the risk-free rate will decrease the value of puts. So Rho is positive for long calls and negative for long puts. Now, when we're talking about this, it's always that all other things equal. So often people get a little bit confused with Rho because they say, well, if interest rates fall, you'd expect stock prices to go up. That's not what we're talking about at all. We're imagining that interest rates either rise or fall. It has no impact on the price of the underlying. We're simply looking at the present valuing impact with Rho. So other than under extreme circumstances, the value of an option is not hugely sensitive to changes in the risk-free rate. It will change the value of the option, but it's not a massive risk factor. It's nothing like things like delta, for example, or theta. And for that reason, Rho is, it's something that an options trader will look at, but it's not going to be the number they really stare at on their screen all day long. It's one of the least used of the first order Greeks. Now, Vega is our next Greek, and Vega is a very important Greek. So Vega measures the sensitivity of option prices to changes in the volatility of the underlying asset. It's the first derivative of the Black-Scholes options price taken with respect to volatility. So mathematically, that's what it is. But what Vega is telling us is how much does our option price change when the implied volatility of the underlying asset changes. Now, one of the core Black-Scholes assumptions that we talked about in last week's class was that volatility stays constant over the life of the option. And that is an assumption, and it's required in order to have a neat and tidy formula like the Black-Scholes formula. But in the real world, of course, volatility or implied volatility is changing constantly, basically as news comes out. So we'll say, for example, if there's a big piece of news about, we'll say if a war breaks out, well, that's going to increase volatility because we don't know what is likely to happen with asset prices, right? So all sorts of news events will be causing volatility to rise and fall, not just day to day, but minute to minute within the markets. And so in the real world, sigma or volatility does not stay constant. And so Vega helps us understand how the options price changes when volatility expectations or implied volatility changes. And so obviously if you're long or short options, you care about how a change in market sentiment about how volatile the market is likely to be is going to impact the value of your portfolio. So Vega is a very important Greek. Now let's talk a little bit more about volatility here. Our next slide starts out saying option owners love volatility. And that's because whenever you buy an option, it doesn't matter if it's a put or a call. And often this concept is hard to get your head around. I remember the first time I had this explained to me, it didn't seem to make sense. I thought, well, if a call owner loves volatility, then shouldn't a put owner hate it? And the answer is no, because volatility is just standard deviation. It's the amount that the underlying shakes around, how much it moves on a daily basis. And so something that moves a lot, something that's volatile or risky, because often within finance we use standard deviation as a descriptor of risk. And the more risky something is, the more it moves around a lot, the higher its standard deviation is. And the more something is moving around a lot, the more likely it is to either make a put or a call be in the money by expiration. So the example I like to use is something like a biotech stock. So if you've got a biotech stock and they're testing a new compound, and the news is going to come out in a week's time, and we're going to find out that their new drug is going to cure all known diseases, and obviously that would be great for the company. Or we might find out that that new compound has harmed everyone who was involved in the clinical trials, and that there'll be huge lawsuits against the company. So we can fairly say that this is a risky company, that this is likely to be very volatile, because if things go well, they'll go really well, and if they go badly, they might go horribly. And so you'd expect both puts and calls to be more expensive on that exciting biotech stock than, we'll say, a company like a water utility that just sells water. The price that it charges its company is usually regulated by a government entity. And so while you wouldn't be at all surprised to hear in a week's time that the biotech stock has doubled or halved in price, you'd probably be horrified to hear if the water utility had moved more than 1 or 2% over the same time period. So obviously, with our volatile underlying, our biotech stock, the person who's going to sell you a put or a call on that is going to have to charge you more money, because it is riskier for them to sell that than they're going to charge you for our low volatility stock. So both puts and calls increase in value when volatility increases, because essentially either of them could be pushed into the money. Understanding how and why volatility impacts options prices is key to understanding options. So understanding volatility, which we're learning a lot about in today's class, I would almost argue is the most important thing in understanding options and why people invest in options and how they pay off. So that is Vega, and we're going to learn more about volatility later on in this class. So our next Greek that we're going to look at here is called gamma, and gamma is the first of our second order Greeks. So by that it's a second derivative of the Black-Scholes options price taken with respect to the price of the underlying. So what this means, why it's a second order Greek, is instead of it telling us how much the price of the underlying changes, what it's telling us is how much another Greek changes, how much delta changes. So gamma measures the sensitivity of delta to changes in the price of the underlying. So gamma will tell us for a 1% change in the price of the underlying how much delta is likely to change. And as we know, delta does change when there are bigger moves. Delta holds quite reasonably well for small moves, but if there's a bigger move, delta is going to change. So if gamma is small, if we calculate gamma and it's quite a small number, what that is telling you is that for changes in the price of the underlying, the delta doesn't actually change that much, and therefore you won't have to re-hedge it off as often. So really what gamma is telling you is that options that have a low gamma don't require as much readjustment of the hedge as do options that have quite a high gamma. So if gamma is large, then delta is very sensitive to changes in the price of the underlying, and therefore you're going to have to be constantly adjusting your hedge. So that is gamma, and that is a second order derivative. So gamma helps us understand how our portfolio will behave for larger movements. Delta is not as informative for large market moves. Delta neutrality provides protection against small movements, right? So earlier we talked about the idea that if you had a portfolio of options, you own a number of options, some are puts, some are calls, you're long some, you're short some, and you're able to sum up the delta and know what your portfolio delta is. So once you're delta neutral, you know that for small swings, we'll say if the market goes up or down 0.5% that day, you kind of know that your portfolio should not be changing very much in value because of that move. Now, gamma tells us how much that delta is likely to change. So if you have a gamma neutral portfolio, that means that you have to rebalance less frequently. Now, you can't trade the underlying to change your gamma. That will change your delta, but not your gamma. You usually have to add more options in order to get a gamma neutral. So you can be delta neutral and you can be delta gamma neutral. So creating neutral portfolios is our next slide. And using a stock and an option, a trader can create a delta neutral portfolio, right? So if you either buy or sell an option, you can then calculate its delta, trade the underlying against it, and create a delta neutral portfolio. Now, if the trader wishes to further reduce sensitivities to other factors such as gamma, they can do this by adding another option to the portfolio. And in general, for each Greek that we wish to hedge, you'd need to add at least one additional option to the portfolio. So that's our Greeks. Now, there are many more Greeks than the ones that we've discussed. And, you know, if you're really interested in this, take a look at your textbook, and it describes many Greeks. And there are many more that are not even in the textbook, because you can keep calculating on almost forever, third and fourth order Greeks if you wish to. But the ones that you've learned about today are the most important ones, and they will be of greatest aid to you if you are trading options or using options as a hedge. So that is the Greeks. The next thing we're going to move on to now is the concept of dynamic hedging. And dynamic hedging is very important for options traders. Now, options existed, as we mentioned earlier, long before mathematical methods for pricing them did. And once these models came along, options prices did not actually change that much, because people had iteratively worked out sort of reasonable prices for these options. But the big thing that our options pricing models taught traders was how to dynamically replicate the payoffs by trading in the underlying. So let's think about what I've just said and what it means. So once you have these mathematical models, you're then able to calculate your Greeks. Before you had these models, you weren't able to know. You had to sort of estimate how much your option value would change for a 1 unit change in the price of the underlying, for example. Now, once we know about things like delta, we're actually able to replicate the payoff of an option without actually owning an option. Now, that's a big idea, and hopefully by the end of the class you'll understand it, but I'll try and plant the seed right now of how that works, and then I'll explain it in greater detail. So if you think about the delta of an option being equivalent to owning a certain amount of the underlying. So we said that if there is an option with a delta of 0.5, that's a lot like owning a half of a share in the underlying. Or we'll say if the option covers 100 shares, it's like owning 50 shares in the underlying rather than owning the full 100. So if you were to calculate the delta of an option without owning the option and simply just trade that delta in the underlying, you would actually end up with the payoff of the option. So as the price goes up in the underlying, you'd expect your delta to increase. And so the more the price goes up, you'd find yourself buying more of the stock. The more the price falls, you'd find yourself selling some of the stock. And by the end, by the expiration date, you'd expect all of that trading to actually pay you out as much as the option would have paid you out. Now, that's probably a little bit hard to understand at the moment because we haven't gone through it very well, but we're going to look at that in greater detail, and hopefully by the end of this class you guys will have a really good understanding of how options work. So delta neutral portfolios are of interest because they're a way to hedge out the risk of an option or a portfolio of options, right? So if, for example, if we're able to calculate what the delta of our option is, and we're able to, we'll say, for example, if the delta is positive, if it's a delta of 0.5, and we're able to hedge out that risk by selling 50 shares of the underlying, and we continue doing that over the life of the option, constantly recalculating the delta and constantly adjusting the hedge, we end up essentially with our trading replicating the opposite of that option and thus hedging ourselves. So that is delta neutral trading. So suppose you're short one European call option, which covers 100 shares, and its delta is 0.6. What do you have to do to get delta neutral? Well, we multiply 0.6 by 100 shares. That gives us 60 shares, and we need to own 60 shares in order to be delta neutral. So if we're short a call with a delta of 0.6 and we are long 60 shares of the underlying, we are delta neutral. Now, delta only holds for small price movements. So we'll say if this option is 3 months until it expires, the price is going to be moving around, and as it does, our delta is going to change, and that relates to the gamma of our option. Now, as the delta changes, you're going to find yourself buying and selling stock in order to keep yourself delta neutral. If the realized volatility of the stock over the period covered by the option is equal to the implied volatility of the call option that you sold, you would find at the very end that your losses from the constant buying and selling of the underlying stock will exactly offset the premium that you took in when you sold the call option. Hopefully you guys can understand that. So as long as the volatility, as long as the realized volatility ends up being the same as the implied volatility when you traded that option to begin with, the hedging should wipe out the amount of money that you brought in premium, or if you were the person who paid the premium and you owned the option, the trading profits and losses should make you back the amount of money that you spent on premium. So it's really only if the realized volatility is greater or less than the implied volatility when the option was traded that profits or losses are generated if you maintain a delta neutral portfolio. And so that is what we call volatility trading. So if you trade a portfolio of options and the underlying in a delta neutral manner, you are no longer exposed to the directionality of the underlying because that's being hedged, right? So so for moves in the price of the underlying, you're no longer generating profits and losses because you've hedged out your exposure to that risk. You're delta neutral. So what are you left exposed to? Well, we talked about when we were pricing options that really the things that go into the pricing of an option are really just the price of the underlying, the volatility of the underlying, and an interest rate. So really when you hedge out your delta, when you trade a delta neutral portfolio, what you're left exposed to is the volatility of the underlying. And so your profits and losses will relate to the difference between the implied volatility of the option and the actual volatility that the underlying realizes over the life of the option. So let's think a little bit about that, and we will now look at some examples, because often the best way to understand kind of a complex idea like this is to look at the really extreme examples. You know, if you're given a new stereo and it's got all these knobs on it, and you think, well, what does the volume knob do? The best way to work out what it does is to turn it all the way up and turn it all the way down, and then you can kind of see what it's doing. So our next few examples are going to be those sort of extreme examples of the volume either being all the way up or all the way down. And once you understand that when you turn it all the way up, it gets really loud, and you turn it all the way down, it gets really quiet, you can then hopefully understand that when it's somewhere in the middle, what small adjustments to it will do. So let's take a look at some examples. So our first example here is labeled long and wrong. So in this example, we buy a call with 16% implied probability. Now, I deliberately picked 16% as the implied volatility, simply because if you run that through the volatility calculations that we talked about last week, you'll see that really when something is trading at 16% implied volatility, what that is saying is that the underlying is expected to move about 1% a day on average over the life of the option. So if you bought a call with 16% implied volatility and sold the underlying against it, what you're hoping is that the daily swings in that are on average a little bit greater than 1%, and hopefully you'll make money on that. Now, unfortunately, in this example, that's not what's going to happen. So you bought the call, you paid out your premium, you sold the underlying against it, so you're now delta neutral. And what happens going forward now is something really surprising. What happens is the market doesn't move at all. So it doesn't go up and it doesn't go down. It just goes exactly sideways for the next 3 months until your option expires. Now, this is a surprising outcome. This is the volume all the way down, I guess. But so the market does not move at all. And therefore, every time you calculate your delta, the delta is exactly the same as it was before, because the market isn't moving around, and the market has to move in order for gamma to kick in and for our delta to change. So the market doesn't move at all, thus we never readjust our hedge, right? So you've bought the call, you paid out that premium, you sold the underlying against it, and there's no way that you're going to generate profits and losses in buying and selling the underlying simply because the market is not moving. So 3 months later, the option expires. What's your P&L? What profit and losses have you made? Well, you've clearly paid out, you've paid the option premium in order to own that option. The price of the underlying, we'll imagine if it was an at-the-money option, so the option itself is worth no more at expiration than in terms of, it's no more in the money at expiration than it was when you bought it. And clearly the time value did nothing to help you. So you paid the option premium. You clearly have no offsetting profits because you never had to readjust your hedge, not even once. And so you have lost the entire amount of money that you spent in option premium. Now, the person on the other side of that will have sold the option, and we'll say if they're a delta neutral trader as well, when they sold that option, they would have bought the underlying against it, but they were not required to rehedge either. No one had to rehedge. And so at the end, they get to keep all of the money. So they get to keep the entire premium, and you lost the entire premium, and there's no offsetting profits or losses associated with the hedging. So what's just happened there is that you bought a call with 16% implied volatility, but it actually realized 0% implied volatility. So you couldn't have been more wrong about that. And so you lost the entire premium. There was no money made back in the delta hedging. Now, let's now move to our full volume example, and we call this one long and right. So in this example, it's the same example really. We bought a call with 16% implied volatility. So obviously what we're expecting here is that we're hoping at least that the underlying is going to move more than an average of 1% a day over the life of the option. And then in order to be delta neutral, we sold the underlying against it. So just to be clear here, because we bought a call, we bought an option, we've paid premium, what that means is that we are long volatility, right? We're long volatility. So we make money if volatility, if the realized volatility is higher than the implied volatility. So we need it to move more than was priced into the option. So we're delta neutral now, and we're just hoping that the underlying is going to move a lot. Now, this is a much more exciting example than the last one. The market does start moving a lot. So instantly we'll imagine the market falls to zero. So what do you do when the price falls to zero? Well, your delta will no longer be a good estimate of the sensitivity of this option to further move. So let's think about it. It's fallen to zero. What is our delta? Well, if something's at zero, if it moves up 1% from zero, it's still at zero, right? So it's pretty easy to understand that when the underlying is at zero, the delta is now zero. So we had sold the underlying, we were short the underlying. The underlying fell to zero, we recalculate our delta is now zero. So what that means is that we have to buy back the underlying that we had sold. So we have to buy back all of the shares that we had sold when we initiated this position. Now, let's imagine that no sooner have we bought all of those, the stock back, then the stock rockets. It goes way, way up, higher than you'd ever expect it to go. And as we know, a deep in the money call option, is going to have a delta of around 1, right? So what do we have to do? We have to now re-hedge. And so we calculate our delta and we'll say it's 1. And we now have to sell 100 shares short in order to hedge our position. And over, we'll imagine you have the busiest day a trader's ever had, and over, the stock keeps falling either to zero or rocketing up thousands of percentages. And as that's happening, every time it falls, you're buying some stock back. Every time it rises, you're selling the stock short. And all of this buying and selling is keeping you delta neutral, but it's generating, obviously, huge profits, right? So every time it falls to zero, we exit our short position. And when the delta becomes 1, we have to sell 100 shares. At the end of the life of the option, the underlying in this example happens to be exactly at the price it was at when we initiated our position. So all other things equal, if we just bought the option and held it until expiration, we would have, if it was an at-the-money option, it would still be, it would have a value of 0 and be worth nothing. But because we were delta hedging, we generated these huge profits in buying and selling the underlying stock. And in doing so, we have profited from volatility. So the underlying was much more volatile than we expected it to be. And for that reason, we've made a huge amount of money on our hedging. So when we combine these two, we're able to see that if we buy a call, so if we're long volatility, the more the market moves, the more re-hedging you're going to do, and that re-hedging is generating profits for you. Now, if the market doesn't move as much as it was expected to, you're either, if it doesn't move at all, like in our first example, you generate nothing back. If it moves just less than the implied volatility implied that it would, you're going to earn back less money than than you spent when you paid the premium. So then the obvious thing is that if it actually moved at an average of 1% a day, as was expected, you would have made back exactly the amount of money that you spent in call premium, in buying that call option. So this hopefully explains to you how volatility impacts option prices and how an options trader can be a volatility trader. Now, there's no way without the existence of options of trading volatility. It doesn't really work if you just have the underlying. But once you have options available to you, you're able to delta hedge and thus generate profits from volatility. So the volatility that goes into the pricing of an option is obviously one of the most important factors that there is. So, in conclusion, we're on our last slide now. Delta 1 product. So a Delta 1 product is a product that moves in a linear manner in that the amount the underlying moves up or down is the amount that the derivative or the product moves up and down. They pay off entirely based upon the directional move that happens after you buy the underlying. So if you invest in a stock, really the only way of making money in that investment is if you bought the stock is if the value of the stock goes up. Now, because options combine both this directionality in that if you buy a call option and you don't do any hedging, if you just bought a call option, you're able to participate in that directionality. But because the other key factor that goes into pricing that option is volatility, we're now able to combine directionality and volatility together. So you have exposure to volatility as almost a different asset class. You can think then about volatility as the price of the option, because the higher the implied volatility is, the more expensive the option is going to be. And so essentially an expensive option is when the person selling it or the person buying it feels that the underlying is likely to move quite a lot. So you can think, therefore, of the volatility as being like the price of the option. Now, considering you can dynamically replicate the payoff structure of an option, you can have bought one, made money on the trade, but actually have been wrong about the volatility. And a lot of people don't understand that. They think, well, I bought a call option, the price of the underlying went up, and I made money, and therefore that was a great trade. But it might not, you might have made more money had you just bought the underlying, because we'll say, for example, if it did go up and the option ended up in the money and you made some money from that, that's all very nice. But what if you overpaid for the volatility that you actually got? So it's very important to always think about options and the pricing of options in terms of volatility. Now that's the end of this week's class. Hopefully you guys can go through the chapters of the book that covers this. This class, I would say, is in truth maybe the most important class with regards to really understanding options, how they pay off, why they're priced the way they are, and so on. So have a great week, and we'll come back next week and learn a little bit more. Goodbye.